Hi guys, welcome back to my channel. Today I've teamed up with Queenie to talk to you about some beginners investing tips and to talk through a little bit about our favourite low risk stocks.
Hey Anna, thank you so much for having me on the channel. I'm so excited to share our tips with your amazing subscribers.
Before we start, let's just make sure you're aware we are not financial advisors. This is just our own opinion and you have to do your own research before deciding on what you're going to do. Queenie has an amazing channel and she is far more knowledgeable about all things investing than I am. So if you haven't checked her out, make sure you go and check out her channel. So we're going to start off with some beginners tips first and then take you through the stocks afterwards. But do bear in mind that these are just stocks that we've picked based on performance and risk. However, past performance does not necessarily indicate future performance of a stock. So this is why it's important to do your own research and be comfortable with what you're investing your money in. I've said this many times before, but you should never just invest in a stock purely because someone else has said that they've invested in it. And if you do have any doubts whatsoever, you probably want to speak to a financial advisor.
You made me happy, we danced through the night. Life was music and I was your wife. Time flies.
So, tips for beginners. Tip number one is only invest money that you don't need in the short term and that you would be okay losing. Although it's unlikely that you will lose all the money if your portfolio is well diversified, it is still better to be safe and not make the mistake of investing your whole livelihood into the stock market. Choose what works for you individually. Personally, for me, with my individual circumstances, because I've got these goals of building my house in Poland and things like that, I'm planning to invest all my side hustle money and then keep my main salary as my savings towards building this house.
Number 2, diversify. It's really important that when you are investing in shares, you try and diversify your investment. For example, ETFs, which means exchange traded funds, are a really easy way to diversify your investment. And it's also really cost effective as well. ETFs generally outperform stockbrokers who are picking individual stocks. And even Warren Buffett himself is an advocate for investing in ETFs. If you are interested in investing in individual companies, this can be a really great strategy as well. And you may even be able to get better returns than just tracking the market overall in something like an ETF or an index fund. However, with higher returns often comes higher risk. So it is really important that you do your research before you invest in any individual companies. Some things I do before investing in individual companies is make sure I understand the business by analysing the annual report, analyse the financials of the business and the 10K, make sure the business has a competitive advantage which isn't easy to copy, and buy it at a good price when the stock is undervalued. For this, you can look at the margin of safety. But rather than picking individual companies to invest in, which can be a lot of work and more risky, really high-profile investors like Warren Buffett do recommend beginner investors opt for index funds and ETFs because it does diversify your risk and it is a really cost-effective way of owning a small portion of some of the world's biggest companies.
So tip number 3 from me is opt for safer stocks or even better ETFs or index funds. So as a beginner, you probably do want to stay away from individual stocks until you learn how to analyze a company and how to figure out whether or not it's a good investment. You are much better off putting your money into an ETF, which actually consists of a number of different companies, and therefore you are already spreading your risk just through investing into that one ETF. We'll give you some examples shortly. However, if and when you do decide to go down the individual stocks option, so although no stock is completely safe, and it's really important that you understand this, you will be much better off investing in something safe and well established like the national grid over something really risky like Tesla. Yes, we all want to become the next millionaire by finding the gem. Like if you'd invested in Tesla like months ago, you would be laughing right now. But the likelihood of finding such gems is so unlikely that the majority of people will be so much better off just investing into the overall stock market, and that will get them much bigger returns. Also, with things like Tesla, there is so much volatility surrounding it that as a beginner, you really want to strip out the emotional roller coaster. And what you want to avoid is trying to have this experience where you put all your money in a stock like that or multiple stocks like that, and then they crash and you lose loads of money, and then you get completely put off investing, and you just don't want to end up in that situation. And before I get someone commenting saying, but you have some money in Tesla, yes I do, but it's a very small amount, and it was money that was essentially gambling. This isn't where I'm putting in a lot of my individual money, or you know, the majority of my stocks. You know, I have about £1,600 now invested, and only about 85 in Tesla, and I am completely okay with losing every pound of that.
Number 4 tip. There's a difference between investing and speculating. When I first started investing, I was investing in a whole range of things, including cryptocurrency, and I honestly thought that I really understood cryptocurrency well, and I was actually investing in it rather than speculating. However, upon looking back, I was definitely speculating on those investments. It is important that when you are investing in any type of stock or ETF, that you do your proper due diligence and really understand what you're investing in. This can also give you a bit more comfort, and so you'll be a lot less prone to selling your stocks at an undesirable time in the market. So it is important to know the difference between investing and speculating. And before Anna and I start talking about some of these stocks and ETFs, I did want to note that it is important that you do your own research, and past performance on these stocks and ETFs doesn't indicate future performance. So even though you may get some ideas from this video, it is important that you go away, do your own research before you invest in anything. So with that said, let's go back to you, Anna.
So the first stock I want to talk about is the Vanguard S&P 500 ETF. Personally, I'm aiming for this to be one of my biggest holdings. This ETF tracks the performance of the S&P 500. Now, if you don't know what that is, let's pull up the Wikipedia page. So the S&P 500, or simply the S&P, is a stock market index fund that measures the stock performance of 500 large companies listed on stock exchanges in the United States. It is one of the most commonly followed equity indices, and many consider it to be the best representation of the US stock market. So essentially what that means is that by investing in this fund, you are following the overall performance of the US stock market. Now, as you know, I'm mostly a dividend yield investor, so it would be weird for me not to mention dividend yield. Now, this is quite a low dividend yield of only 1.5%. However, it does still pay dividends, and it is made up of the largest companies rather than the dividend payers. And I have other ETFs which track dividend paying companies, but you have huge holdings here such as Berkshire Hathaway, which, if I'm not mistaken, famously don't pay a dividend. So talking of the companies, here are the biggest holdings in this ETF. So as of the 30th of June of this year, the 10 biggest holdings were Microsoft, Apple, Amazon, Alphabet, which is the company that owns Google, for those of you that don't know, Facebook, Johnson & Johnson, Berkshire Hathaway, Visa, Procter & Gamble, and United Health Group. You can also see here a breakdown of the sectors that make up this ETF. The amounts are quite varied, but you can see here clearly the tech giants are overwhelmingly the majority. That's almost double the next biggest, which is healthcare. In case you're not aware, most ETFs will have some ongoing charges. So in terms of this one, the costs on this ETF are ongoing charges of 0.0701 and transaction costs of 0.0127. So what does that mean? Well, if we use the free trade example here of investing £5,000 over 5 years, after the 5 years, at a £5,000 initial investment, assuming an underlying return of 5%, you will pay £25.11 in charges. You can see here on the screen as well the average annual returns of this ETF. It's pretty much consistent with the general S&P 500 index, and you've got 7.5% 1 year, 10.69% 3 year, and 10.68 5 year. So I personally think that it's a pretty decent investment. It's better than I'm gonna get at a normal bank account, you know, so even if one of those companies go down, I'm less likely to suffer a loss, and that's why I want this to be the majority of my portfolio.
The second stock that we have on our watch list is iShares 100 Global ETF, and the stock ticker for this ETF is IOO. So what is iShares 100 Global ETF? This is a fund that tracks the performance of the S&P Global 100 Index. This ETF is made up of 100 multinational companies of major importance around the globe. And here are the benefits of investing in the iShares 100 Global ETF. You have the benefit of investing in a range of different companies from around the globe. Number 2, since it is only one investment, you are getting 100 of the world's biggest companies in your investment, so therefore it is more cost effective than if you were to go out and buy shares of all of these companies individually. And number 3, since it is a global ETF, your risk is more diversified. The management fee of this ETF is 0.4%. This means that if you invest $10,000 or £10,000, you'll pay $40 or £40 in management fees. The top 10 holdings in this ETF make up 48% of this ETF's investment. And the top 5 biggest companies in this ETF are Microsoft, Apple, Alphabet or Google, and Johnson & Johnson. And the geographic breakdown of this ETF is mainly in the US, however there are some companies also in Europe and in Asia as well. The 2 biggest sectors which make up this ETF are IT and health. And here are the results from the past 1 to 5 years of this ETF. In the past 5 years, this fund has had an annualized return of 11.87%, and the returns have been 2.98% since this fund's inception in the year 2000. It is important to remember that past performance of this fund doesn't indicate future performance. So I hope you enjoyed this little snapshot of the iShares 100 Global ETF. I'll give it back to you, Anna, to explain more about your stock pick number 3.
So I wanted to get like one individual stock in here just to show you what I mean by safe individual stocks. Just to reiterate, this doesn't mean you should be investing in this stock. It just means that this is what I look for in individual stocks that I invest in. The stock I want to talk about is AT&T. Now, if you've been watching a lot of finance videos on YouTube, you will have heard of AT&T. It's a pretty common favorite amongst like the finance YouTubers and just everyday investors. So AT&T is the largest telecoms company in the United States. As of 2020, it is actually the 9th biggest company on the Forbes 500 list. It actually has a huge dividend yield of 6.9%. So now you can see why this is a favorite amongst a lot of investors, especially dividend investors. But as you can see on this chart here, the growth on the actual share price is not great. It just sort of stays around the same level. So this one is definitely a dividend investor preference. I wouldn't suggest going for this if you're looking for sort of growth investing rather than dividend investing. AT&T have consistently grown their dividends for 36 years, so a lot of investors see this as a great addition to any dividend portfolio. I'm not going to go too much into the individual sort of ratios and analysis and stuff like that. I have a video going into, I'm going to link it up here, going into the different sort of bits of analysis you should do on individual stocks if you're thinking about investing in them. I don't want to make this video too long, but what I wanted to try and show is that there is a stock here that has been around for a long time. It's one of the biggest telecoms companies. You know, even in the current climate, telecoms companies haven't been under threat as much as say other companies. The one thing that I would say with AT&T is, although I've thrown it in here because it is one of the biggest sort of stocks that is considered a safe stock, there has been something that's come up recently which has me a little bit worried, and it means that I'm going to be watching the company, and that's why I'm saying do your own research, is that actually their dividend cover has just dropped below 1. Now I'm going to see what the next statements look like and whether this changes the position. At the moment, I'm keeping it in purely because of the history that they've got, the fact that they're the largest telecoms company, the 36-year growth of dividends, and my risk appetite. So that just shows, like, even if a company is considered safe, there might be issues that arise with it. So when you invest into individual stocks, you need to be constantly monitoring how they're doing and being ready to potentially make a decision to pull out if you no longer feel comfortable with it. So that's kind of why I wanted to choose this stock, to show you that although it's considered a safe stock, there may be some issues.
Thanks so much for that, Anna. And now I'm going to share the stock pick number 4, which is the iShares MSCI Global Impact ETF. and the ticker code is SDG. So what is it? This ETF tracks the performance of positive impact companies that generate revenue from solving some of the world's biggest problems in both social and environmental issues, which are identified by the UN's Sustainable Development Goals. So why should you consider investing in this ETF? Here are the benefits. Number one, you'll be investing in companies which have a positive impact on our world, and especially towards issues like climate change and education. And number two, you can feel good about your investments knowing that you're investing in companies which are driving positive change, and you're still buying into some of the world's biggest global companies and building your investment portfolio. The management fee of this ETF is 0.49%, which means that if you invest $10,000 or £10,000, you'll be paying $49 or £49 in management fees. The top 10 holdings in this ETF make up 38% of this fund. And the top 5 biggest holdings in this ETF are Tesla, Umicore SA, AbbVie Inc., Vesta Wind Systems, and Procter & Gamble. And the majority of the companies in this ETF are in the sectors of health, consumer staples, and industrials. And here are the results from the past 3 years of this ETF. Since the fund launched in 2016, the annualized returns have been 10.4%. So I hope you enjoyed this quick snapshot of the iShares MSCI Global Impact ETF. And thanks again for having me on the channel. I've really enjoyed doing this video with you, and I'm so looking forward to the next one. I'll pass it back to you, Anna, so that you can wrap up this video and give us all some key takeaways.
So in conclusion, there are so many different stocks and ETFs to choose from, and a lot of this will depend on your own individual risk appetite and the direction that you want to take your portfolio, i.e. growth or dividends, things like that. Make sure you do your own research into every single company that you want to put your money in and that you feel comfortable with investing into that company. Thank you so much for watching. Make sure you don't forget to check out Queenie's channel, and we'll see you in the next video. Bye.
Past the creek where we used to swim, jump the fence before the summer begins, and getting cool in the summer